You've got $1,000 saved up, just sitting there, doing nothing, and every month that passes, it's losing value. Yes, even if you never touch it, even if you take good care of it, inflation is quietly eating away at it while you wait for the perfect moment to invest. And here's the real problem. Nobody ever taught you what to do with that money. Not in school, not at home. So today we're fixing that. I'm going to show you exactly what to do with your first $1,000 in 2026, step by step. And at the end, I'm going to tell you something about compound interest that almost no finance video actually explains. Before you put a single dollar into any investment, you need to understand something important. Investing isn't a lottery. It's not about guessing which stock is going to jump tomorrow. Investing is basically buying yourself a small piece of the future. When you buy a stock or a fund, you're buying a tiny slice of real companies that produce, sell, and grow over time. And here's the key point. Almost nobody repeats enough. Time matters more than the amount. You don't need to be rich to start. You need to start in order to eventually become rich. But before you invest a single cent, there's something you need to check first. And if you skip it, you could end up worse off than when you started. Step 1, and this one's non-negotiable. Before you invest, you need a safety cushion. Why? Because if you invest everything and your car suddenly breaks down or you lose your job, you're going to have to pull that investment out at the worst possible time. Probably at a loss. The general recommendation from personal finance experts is to keep 3 to 6 months of basic expenses in an easily accessible, non-invested account before you start investing more aggressively. If your $1,000 is literally your entire savings, the smartest move might be to set part of it aside as a cushion first, and only invest what you genuinely won't need in the short term. This isn't the exciting part of the video, I know, but it's the part that keeps you from losing money for the wrong reasons. And what's coming next is even more important. Step 2, and this is the one that saves people the most money without them even realizing it. If you have high interest credit card debt, pay it off before you invest. Why? Think about it this way. If your credit card charges you 20% interest a year and you invest hoping to earn 8 or 10% annually, you're losing money on net. You're swimming against the current. Paying off high interest debt is mathematically one of the best investments you can make because it's a guaranteed return the moment you eliminate that interest. Now, if your debt has a low interest rate, like a student loan with a reduced rate, it can make sense to invest in parallel. But wait, because it gets even better when we talk about where to actually put that money. Step 3, before you open any random investment account, check whether you have access to tax-advantaged accounts. In the United States, for example, there are accounts like a 401k with employer matching or an IRA, which let you invest while paying less in taxes or even receiving extra money from your employer. If your job offers a matching contribution on your retirement plan and you're not using it, you're basically leaving free money on the table. Free money on the table. Every country has its own version of these accounts. So before opening a regular investment account, look into what tax-advantaged options exist where you live. It could be the difference between earning 10% or earning 10% plus a tax break. And now that you've got the basics covered, let's get to the part everyone's been waiting for. Where to actually put that money? Here's the question everyone asks. Should I buy shares of one specific company or something more diversified? For the vast majority of beginners, the answer that long-term financial studies point to is clear. Index funds. An index fund is basically a basket that holds hundreds or even thousands of different companies at once. Instead of betting all your money on one single company succeeding, you're betting that the economy as a whole keeps growing over time. And here's the interesting part. Long-term financial studies show that most professional investors who try to pick individual stocks don't consistently outperform a simple index fund. With $1,000, buying a diversified index fund gives you instant exposure to hundreds of companies with no need to guess which one is going to be the next big stock. Simple, diversified, hard to mess up. And this is where things get complicated for most people. I promised you at the start I'd tell you something almost nobody explains about compound interest. And we're almost there. But first, you need to avoid the mistake 90% of beginners make. That mistake is getting in and out of the market based on emotion. They buy when everything's going up because they're afraid of missing out, and they sell in a panic when the market drops. And here's how you avoid falling into that trap without needing superhuman willpower. Automate everything. Most investment platforms in 2026 let you schedule automatic contributions, weekly or monthly, directly from your bank account. Why is this so powerful? Because it removes the emotional decision from the process entirely. You don't have to decide to invest every month. It's already happening on autopilot while you get on with your life. With $1,000, you could, for example, invest part of it right away, and then set up small, consistent consistent contributions each month going forward, even if it's just $50 or $100. What matters isn't the initial amount, it's staying consistent over the years. And what behavioral finance research discovered after years of studying this changed everything we thought we knew about why everyday people lose money investing. It's not a lack of knowledge, it's a lack of consistency. Now let's talk tools. In 2026, there are countless platforms for investing with a small amount of money, and most of them share a few things in common: zero or low commissions per trade, very low minimum amounts, and the ability to buy fractional shares of stocks or funds. Instead of recommending one specific app, since that varies by country, here's what you should look for: low or zero commissions, verifiable official regulation, fractional share purchasing, and the ability to easily automate contributions. Look into which regulated platforms operate specifically in your country, compare their fees, and always verify they're registered with the relevant financial authority before depositing a single dollar. And now, let's get to the exact plan for what to do with your $1,000. Here's the practical summary, the plan you can start following today. 1. If you don't have an emergency fund, set aside part of your $1,000 for that first. 2. If you have high interest debt, prioritize paying it off. 3. Check whether you have access to a tax-advantaged account through your job. 4. Invest the rest in a diversified, low-cost index fund. 5. Automate future contributions, even small ones, every month. You don't need to make this any more complicated than that. The people who lose the most money investing are the ones who try to overcomplicate it, chasing some secret formula that doesn't exist. And now, like I promised you at the very start of this video, let's talk about the thing almost no finance documentary explains properly. Here's what almost nobody explains well about compound interest. It's not just that your money grows, it's that the earnings from your money start generating their own earnings. $1,000 invested today, left to grow for 20 or 30 years untouched at a historical average market return, can multiply several times over its original value. Not by magic, but because every year you're earning money on top of money you already earned before. The real secret isn't finding the perfect investment, it's starting early and not stopping. Let me know in the comments if you've already started investing your first $1,000, or if this video helped you take that first step. If this video helped you, subscribe and hit the bell. Next week, we're continuing this series, what to do after your first $1,000.